Module 8. Stock valuations. Book value per common share. Book value per common share measures a company's net worth per share of common stock. It represents the amount of stockholders' equity applicable to common shares divided by the number of outstanding shares. The formula for calculating book value per common share is book value per common share equals stockholders' equity applicable to common shares divided by number of common shares outstanding. Stockholders' equity applicable to common shares is the portion of the company's total equity that belongs to common shareholders. It is calculated by subtracting preferred stock dividends or other claims on the company's assets from the total stockholders' equity. Capitalization of retained earnings. When a corporation issues a small stock dividend, it distributes additional shares of its common stock to its existing shareholders. The dividend is considered small if the number of shares distributed is less than 20 to 25% of the outstanding shares. Unlike a cash dividend or a large stock dividend, a small stock dividend does not require the company to transfer any assets out of its retained earnings account. Instead, the company transfers a portion of its retained earnings to its paid-in capital accounts to reflect the increase in outstanding shares. Specifically, the accounting treatment for a small stock dividend involves debiting retained earnings for the market value of the shares to be distributed and crediting common stock dividend distributable for the par value of the shares to be distributed. When the shares are distributed, common stock dividend distributable is debited, and common stock is credited for the par value of the shares. Therefore, in the case of a small stock dividend, there is no capitalization of retained earnings based on the par value or market value of the shares outstanding or to be distributed. Stock dividends. A stock dividend is a distribution of additional shares of a company's stock to its existing shareholders. It does not involve any transfer of assets or liabilities and does not affect the company's total equity. Instead, it transfers amounts between the components of equity. A stock dividend increases the number of outstanding shares of common stock and reduces the per share value of each share. This reduction in per share value is offset by a corresponding increase in the number of shares held by each shareholder, so the total value of each shareholder's investment remains the same. As a result, a stock dividend affects the composition of equity rather than the total amount of equity. Declining a stock dividend usually rests with the board of directors rather than the shareholders. The board may declare a stock dividend to provide additional benefits to shareholders without using up the company's cash reserves or to signal confidence in the company's prospects. Carrying value of a long-term note payable. The carrying value of a long-term note payable is the total amount that a borrower owes to a lender at a particular time, including the face value of the note and any accrued interest. It represents the liability on the borrower's balance sheet. When a company borrows money through a long-term note payable, it agrees to pay back the face value of the note at maturity, as well as any interest that accrues over the life of the note. The interest is typically paid in regular installments over the life of the note. To compute the carrying value of the long-term note payable, we add up the face value of the note and the total of all future interest payments. This is because the face value represents the amount borrowed, while the interest payments represent the cost of borrowing. Statement of cash flows, the indirect method. The indirect method of preparing the operating activities section of the statement of cash flows starts with the net income figure from the income statement. Then it adjusts it for non-cash items and current asset and liability account changes that affect cash flows from operating activities. This method is more commonly used than the direct one, which reports each central operating cash receipt and payment item.